So what we're going to do, I'm going to turn to Christian first and lay out really the 4 primary liquidity options for private companies today. The traditional IPO I mentioned, direct listing has emerged a little bit, but some high profile companies have gone that route. I think we'll see more of it. Obviously, selling the company is still an option, but our focus today is really on SPAC. So Christian, key us in on each of those opportunities, each of those paths. What should our audience know and have a special emphasis on SPACs?
Sure. Okay, so I'll go through all 4, and I'll spend the most time on the 4th. But the first was the traditional IPO, was where you would take a private company and you would go through a process. You would meet with the banks. You would prepare your S1 registration statement. You file it with the SEC, and from start to end, you had maybe a 4 or 5 month process. And at the end is really where you got the real sense on valuation, because markets move. And that's how transactions were done. And you'd price a transaction at a certain price. And let's say it's a real 4 month process from saying go, maybe longer, certainly longer in some situations. You have to get your financials ready, PCAOB. And that was the process. I think it still is. And I think many people here are familiar with this. Option 2, and these are all have similarities. Option 2 was something that I think Spotify did, direct listing. And that's where the company would simply list on an exchange without selling shares through underwriters as you would in a traditional IPO. But that transaction historically, and changes are being worked into it, didn't include fundraising. It simply included listing a company and then having liquidity for the existing shareholders. And there's been only a few of them, obviously, but there have been thousands of traditional IPOs. There have only been a few direct listings recently. Sale of the company is when you sell to, in my world, let's say it was privately held, you would sell to a private equity fund who would own it outright typically, or you sell it to a strategic company in that space that want to do an add-on acquisition. And that strategic company may also be a public company. So that was really the sale of the company. So just walking through, in number 1, traditionally the sellers would retain even though you're doing an IPO, the sellers retained a very large interest. Number 2, direct listing, the sellers retain all the interest, they're just creating liquidity. Number 3, sale of the company. Typically, when you sell the company, you're selling 100% of the equity. There are situations, obviously, where there's management rollover, maybe a little bit of rollover for the existing sellers. But usually if you went, let's say, private equity to private equity fund, or you went to a strategic, you really didn't hold on to ownership. It's mostly an outright sale. So then we get to the 4th phenomenon. I'll spend a little bit more time on this, a SPAC. And I think you all know, and I'll just go through it quickly. A SPAC is an entity that goes public on an exchange. It raises cash. It usually issues a unit that contains a stock and a portion of a warrant, sometimes a full warrant, sometimes just a portion of a warrant. And the proceeds it raises from the public sits in a trust account. The SPAC then goes to look for a transaction. And when it finds a transaction, it will sign an LOI. It may seek additional financing. Typically it does in a PIPE. Then it signs a definitive merger agreement. The deal's announced. And about 3 or 4 months later, the transaction closes. The SPAC goes through an SEC process where it presents basically IPO type disclosure on the target company. And target company is a little bit of a misnomer, because usually the company being purchased, actually those sellers end up being the majority sellers of the majority owners of the public company vehicle afterwards. So we say target, but it really is more, it should have a different term. It really should have a term like partner or something like that. So and it does in some deals. So in the SPAC transaction, the big element of it that's different is when the SPAC goes out for its shareholder vote, at the same time, it offers its existing shareholders the right for those shareholders to have their shares redeemed. at the money at $10 plus whatever interest has accrued on the account. So that is the SPAC. You can raise money, you put it in trust, but you have to offer redemption rights when you find a deal. Okay, now let's look at it from the seller's perspective. So I think 1, 2, and 3 were pretty straightforward. I think sellers generally understand that. Now we get to 4. Well, why would you do a SPAC? Why would you sell to a SPAC if you could just do a traditional IPO? And here are the main differences and why I think this has gained momentum. SPACs have been around for a long time. The term wasn't used in everyday parlance like it is now. So if you looked at private companies, it was kind of an option of last resort. Then there were a few, I think, significant developments. One, large private equity funds like Blackstone, Bain, they started selling to SPACs. So that created momentum. People say, well, what is this? And why are they doing this? And the why is, if you look at a SPAC transaction as a seller, in the seller's shoes, okay, you're first negotiating with a SPAC and you come up with an LOI. That LOI has a valuation in it. So essentially, you're talking to a SPAC, let's say in 3 weeks, you've landed on a valuation of what the SPAC is willing to do a transaction at and what you're willing to do a transaction at. So basically, you have flipped the process of getting to valuation from option 1. In a traditional IPO, you find out what the market's willing to pay you only 4 or 5 months after you started the process. In the SPAC transaction, you're saying, okay, here's the valuation we're going to do. Then the seller says, you know, SPAC, you have this trust account. And while we believe in ourselves, the market may not believe in the story, even though they should. And so we may have a lot of people redeem, but we're not doing a deal where there's no cash for us. Not that we necessarily need the cash paid to us, but the seller may say, I need to delever. So a lot of these transactions are simply deleveraging transactions, very similar to a traditional IPO. So the SPAC and the target will agree, okay, we all agree we want more money in this. We want money, much more certain money. So they go out and do a PIPE transaction on a confidential basis, and they get investors signed up to say, I will fund into this deal. And I effectively have it's a committed financing. I have very little outs. I will fund into the deal. So once that PIPE is established, and the beauty of the PIPE not only is committed financing, but also you've now tested the valuations. It's not just the seller and the SPAC. You've gone out to third-party investors, maybe a Fidelity and T. Rowe, and said, hey, we need to raise money. When they come back and say, I'm in at $10 a share, you've now provided some price validation. You've done price discovery. And now you're hearing, okay, big third-party funds are interested at this price. So now your deal has some momentum. Then you announce the deal. You're saying, here's the valuation. I have committed financing. So I'm not that dependent on everything in the trust account. And you announce the deal. Now, another big difference I think sellers will like, two main differences in this is that the SPAC often markets itself after announcement with projections. And that is not something you see in option 1 in a traditional IPO, or frankly, option 2. And people are just worried about, especially option 1, people are worried about the liability doing a traditional IPO of showing projections. It's not that the SEC doesn't want you to. My view is actually they encourage it. But you have banks involved. No one wants to take all of this liability showing projections. Whereas in the SPAC context, there isn't technically an underwriter with underwriter liability. And also, since the SPAC's board has seen the projections and the PIPE investors have seen the projections, the model's built so that the projections are disclosed. And I think the other panelists who are much closer to the business side will probably, maybe, certainly, hopefully add on to some of the things I've said because I sound too theoretical right now. Then the last piece of, so we have all that. The other piece I think sellers will like is what you don't see in a traditional IPO, and you don't see in a direct listing, and you might see in a sale of company, but you don't have seller earnouts. Now, it doesn't happen that much, but there are de-SPACing transactions where the sellers say, we believe our company's worth X. You only think it's worth Y. We'll put our money where our mouth is and we'll take an earnout. We'll say, okay, we get X amount of shares and only vest if the underlying stock, let's say, hits $15. So I think that's another nice feature for the sellers to have. So those are really the big differences, I think, among the 4 options. The other phenomenon I've seen, I'll do it quickly, is with private equity funds, what we've seen is as their funds come to end of life, they would like to retain an interest in a company, but they also need to get liquidity for their fund investors. And so the way of doing that typically has been a traditional IPO, but again, you only get valuation on the back end, direct listing, but really there's very few of them. Sale of the company, unlikely, because usually you're selling 100%, so the GP's out. So the SPAC has been an option for private equity sellers.